Well, good morning, everyone. This is Glenn Thompson, and let's see, it is about 7 minutes after the hour, so I actually took a little longer than I thought, but we're going to start. And welcome for those of you who've visited some of my previous webinars. Welcome again for those of you who may be listening to a webinar I presented for the first time. I offer my initial welcome. I'm glad to have you. Today's topic, or the title rather, is the power of trend analysis. Trend is the most important analytical component of all the work and research that I do. Just a brief intro before we begin here. As you see on the screen, you have my name, Glenn Thompson, and I consult as a mentor with Pacific Trading Academy and have been doing that for close to, not quite 15 years since the inception. I've actually been trading for more than 30 years. If you want to reach Pacific Trading Academy or possibly myself, the way to do so would be to utilize the contact information. You see the toll-free number on the screen, 800-339-8588. You can also take a look at the website, www.pacifictradingacademy.com. We are recording today's webinar as we typically do, and then it's uploaded to our site. And I think now in the last couple of months we've been putting them on YouTube as well. So there are a number of ways you can listen to this or re-listen to this broadcast if you miss any portion of it, or if you'd like to review, as well as any of the webinars I've done over the last few years. They're archived on the site. If you'd like to get more information concerning any of the instructional programs that we offer as an institute, as well as any more specifics on what I do and how I do it, the person that handles all of those, I guess the overseer and officer of admissions, Peter Newman. So you would want to request Peter Newman, or if you get a call from him, it would be concerning that. So he acts as my representative in terms of contractual arrangements and anything we do. Okay, great. Let's begin. Trend analysis. I from time to time talk about the trend. It is, to me, again, at the precipice of the analytical forefront in terms of the analysis and research I do to try and locate and acquire as much edge as I can in my trading. So let me show you a little bit of the ideas that I use to which incorporate trend, which help me identify trades. Let me start by saying, and this is a slide I use off and on when I'm talking about trend. Essentially, as I see it, there are two major ways of approaching or thinking about how one should apply analysis to look for a good trade. One is the trend analysis, or a pure trend analysis approach, and then there's everything else. Most traders, myself, when I would also would have put myself in this category, again, when I was about in my mid-20s when I first started, was attempting to apply the alternate idea, which is to follow, or rather anticipate when markets were going to change. And I would venture to say that 80% of all models and indicators and relationships that investors and speculators apply and use is to assist us in our effort to try and forecast in advance when and where, those are the two dimensions, price and time, a market's going to change. The idea being, if I, with any appreciable degree of accuracy, can project in advance before the crowd, before the trader on my left and the right can realize or understand and anticipate when a market's going to turn from a perspective of price and time, that imputes to me an implicit edge. And so I would say the majority of all that's written, all that's thought about, all that's tossed back and forth among traders in conversation and in thought, and what we spend most of our time reflecting on, for the most part, are those ideas and relationships and models, again, which enable us, when they work, to project in advance turning points. And so that tends to be the ubiquitous paradigm. So that's one idea. Trying, and when it works, it accomplishes that to some extent. you can get some edge. If I know in advance where and when a market's going to turn, analytically, that enables me to get positioned in a manner that can exploit and take advantage of the rest of the market. The complete alternate universe or parallel universe is to follow. In the extreme limit, make no attempt to anticipate and understand and project when a market's going to turn, but rather wait till it has turned. And recognizing such, get on board. Just follow and ride that proverbial wave, so to speak. So there are these two polar opposite analytical strategic approaches, if you will. And so I always, in a sense, when they are mutually exclusive in an intellectual, at the forefront, they tend to be at odds. In order to, in a pure sense, purely follow with reckless abandon, you kind of have to purposely be agnostic and not know what's going to take place moment by moment. Just merely follow and get in alignment with what's occurring. Ride that wave for all it's worth. That's the pure trend analysis approach, which is at one kind of extreme way of thinking about how to do this. The completely opposite universe would be to build up a cadre of tools and techniques and relationships that will enable you with some amount of accuracy to consistently anticipate when it is a market and where it is a market will turn. So I thought it would be, since I happen to intellectually kind of align and I kind of like both ideas, why not see if there's any way we could meld? Can I have one hemisphere of my thinking or brain work with the pure following, the pure pristine trend analysis, which seems to be kind of like a Zen approach to trading, while at the same time the alternate hemisphere of my thought and work can be hewing to all of those ideas that I think are best suited to projecting and giving me some insight into the future. So essentially, this slide depicts a little outline as to in terms of how I do this. You can pay no attention to the man behind the curtain, the phone ringing. I should have disconnected that line prior. By the way, folks, if you have questions while we proceed, you can, someone's indicating no sound. Let me double check here. Maybe that's the monitor this, so. Let me, okay, let's try, is not right now. Let's try this. Let's back out one moment. And okay, let's try it now. If no sound, you're back. Okay, okay. Thank you for that feedback, folks. I guess that's what the phone call was. Someone was trying to notify me. There is sound. All right, no sound. It was fine. Problem was on that. We have sound. Sound is returned. Thank you. So I'm going to work on the premise that we have the sound. Let me restart the slide presentation here. One moment. Be right back. Okay. I'm not quite certain at what point we lost audio, so I'll do a brief synopsis. I had given a brief kind of commercial to indicate that if you want to reach us, you can use the contact information on this screen. I think we didn't have a problem for that, and if not, I'll repeat it at the end. What I had mentioned also is at any point during the course of the presentation, you have questions, write them in on the control panel in the way you've been giving me the feedback concerning the technical issues. So I appreciate that. And then as I periodically take a look, if there are questions that I can, in a very brief manner, address so as not to interrupt the presentation, I'll do so. And then there's time at the end so I can go into more detail to address any questions if there are any. Okay, what I was saying, just to provide a brief recap, there are two basic camps, if you will, or philosophies of analytical ideas that investors use. One is, and they're opposite, they kind of occupy opposite views or universes of thought, parallel universes, if you will. They're very polar opposite. Trend analysis, in the way that I want to discuss today, is one idea. And it basically operates from the premise of work with no information, just allow the market to be your guide, if you will, through the terrain of price returns as it moves forward and evolves forward through time. To the extent you can the more time and everything one can do as a speculator or an investor to maximize the amount of time that your positions that you've established in a market are in strict alignment with that motion is the extent to which that will serve to optimize the financial return you're able to extract from a market's move. Kind of like the idea, an old idea. I remember in grade school reading a book about Albert Einstein asking a question, what would the universe be like if you were to ride piggyback or on the backside of a light particle, a photon? So again, imagine in the limit, if you would, how much money you could take out of a market to the extent you were positioned in strict direct alignment with every fluctuation. Now there's a limit to how well one can do that because they're what I call collectively frictional forces. It takes some time to get a position established. The mere transmission, even if we consider the domain of high frequency trading, the actual time it takes to get into a trade and get it registered, even if it's measured on the order of fractions of a second in the high frequency realm of trading, it takes some time. And then the very next instant or fraction thereof, the market might change. So each and every possible deviation from one price level to another, what academic market researchers refer to as price returns, to the extent one could even approximate being in sync, perfectly in the trend, having established a position in the same vector direction as the trend of the price change. Price is going up, your position long. Price is going down, your position short. even if you could imagine being in sync with that directional alignment of the markets evolving forward through time, 80% of the time, imagine the type of financial percentage return you as a trader could extract. 80% is way too ambitious, but it's an objective. That's the ideal. So the pure trend analysis that I want to focus on today really operates from that. That's the gold standard reference, versus the complete opposite paradigm or philosophy or camp, if you will, of analysis, which what I was saying before we lost the audio. 80%, if not more, of all the literature, all the reflection, all the thought, all the work, all the research on market, on the part of market researchers and the academics who develop new models to try and enable a better forecasting. The attempt to anticipate when in the future a market's going to change, the logic being, to the extent I can acquire and derive an accurate forecast from a time and a price perspective as to when a turn will occur. If I appreciate that, I can exploit it to the advantage of the other traders populating that market, and that gives me an intrinsic edge. So and to the extent one can do that, if you have a repertoire of tools that will enable you to consistently identify ahead of the crowd, the other participants, when and where, time and price, a market's going to turn, form a top or a bottom, yeah, that will give you some edge, certainly. And you can get positioned in advance of the crowd, and your percentage return over the course of a series of trades will tend to exceed that of the average. All right, so which approach does one take? Do we kind of ride the wave as the pure, pristine, kind of Zen-like approach to trading would have us to do, which is choose to, however challenging emotionally it might be oblivious to information that's informing you as to the probabilities of a market turning, and just go along after it has. Recognize what type of motion is in effect, assume some amount or degree of persistency of that motion, up or down, and get on board and ride it for everything it's worth? Do you take that approach on the one hand, which in the extreme at least seems to be the opposite or the mutually exclusive paradigm to the alternative idea of attempting to, with as much knowledge, precisely as possible forecast when these turning points are going to occur? So I think was the point where we left off with the audio was where I was saying I came up with this idea, why not try and meld the two opposite or kind of opposing paradigms? How to converge the polarity, if you will. Always, so very simply, this slide says always start by following. So I always start with the pure Zen approach. To the extent, and how do you do this practically? It's very simple. When I teach people this trend idea, say, ironically, it's the simplest conceptual idea I know. Most traders, they have done study after study that show one common denominator personality trait or type, which is, I guess, an attribute common to many traders, is we tend to appreciate complexity. Well, if there's anything complex in the universe that I'm aware of, at least in this one, financial market behavior and dynamic structure is just that. It's right up there with the weather. To the extent most of the literature and all of my upbringing and studying over the years has focused on the inherent complexity of the financial markets, and there tends to be a commensurate degree of complexity in the tools that we use. To all of a sudden put that on the shelf and just be completely unaware or oblivious to that, psychologically, I think for most, at least for me, is no mean feat. That's quite a challenge. But that's what I'm suggesting we do if we have to compartmentalize this. And so I think I was saying one hemisphere of my brain will be slated for the purpose and labeled pure trend, follow, and be oblivious to everything I know. And the other hemisphere or other compartment of my thinking about how to apply the speculative and utilize the speculative process will be explicitly for the purpose of being cognizant of everything I can and utilizing and matching that with certain models that will enable me to realize what I hope will be high accuracy forecast. Always start by following. So this is the procedural kind of cook recipe, if you will, as to how I do it. I always start by assuming a state of ignorance. Just allow the market to be my concierge or guide through its landscape as best as I can, and continue to maintain that mindset, allowing the portion of my head or thinking that is just following. It's that Zen approach, just to follow until up until my anticipation or forecasting indicates otherwise. And this is the critical stage at point 3, shift internal state from follow mindset to forecast mindset. After market turn, go back to step 1. It's like a computer code, just repeats. So it feeds back. After you reach this step, you just automatically loop back to the first step. So in terms of a flow chart of mental thought process, this would be a guideline that would kind of serve as my blueprint to do this. All right, let's just double check, guys. Are we here still? Okay, great. Yeah, I'm seeing, yeah, hopefully we have it. Okay, so let's progress and show you a little more details to what this is about. This is a reprint from a text that Wells Wilder, based on research, I think, originally Jim Sloman put together. Trend essence. What is a trend? Something is repeating. What is the exact, or what's the most basic form of repetition? Exact repetition. What does exact repetition lead to? Exact repetition leads to symmetry. Symmetrical groups and symmetry, the different types of symmetry gives, of an object or a system. Thank you, Dave, for the affirmative on that. I appreciate that. The different types of symmetry that an object or a system, so in the case of a financial market, be it a stock, and by the way, folks, everything I'm talking about this morning applies to any freely traded market. So if you're an equities trader, if you're a derivatives trader, if you are I don't know, what else? What else is there? Spot currency, Forex, whatever. It will be applicable to you. There are going to be variations as we shift from sector to sector, instrument to instrument, vehicle to vehicle, but at large, theoretically, the ideas are widely applicable. So exact repetition leads to symmetry. So this little diagram on the bottom of this slide currently, the past, indicated by letter A, the present, or what I refer to as the now moment, and the future. On an assumption implicitly that Newton's first law of motion, a body in motion will remain in motion, and or a body at rest will remain at rest unless and until acted upon by an outside force. This is why there is this implicit symmetry in financial markets. So let me go right to, instead of let's make it precise and move from the general to the specific. As far as financial market behavior is concerned, one of the paradigms, that is the pure, pristine, pure trend analysis, where you put your mindset into the philosophy of following, you're going to be led along by the market, is its theoretical underpinning that you can have some confidence in is based on Newton's first law. It didn't just spring up as a great idea. It certainly didn't come out of my head. I didn't wake up one day with this bright idea. I wish I had. It didn't, however insightful Jim Sloman and Wells Wilder's concepts were, they may have independently come to these ideas, but originally, as far as I'm aware, it goes back to the overwhelming insight, I should say, and that's not quite giving it sufficient credence, of one Isaac Newton. This is a consequence of the first law of motion. So every physical principle and law in this universe, and undoubtedly in all others that we are aware of or not, follow to some extent that law. It's not conjecture, it's not a theory, it is a law, the first law of motion. And this is why this symmetrical phenomena that occurs. There is more like this location in where letter C is in the future, from a perspective of time and price, is the most probable outcome for any event in the past, based on that principle. And so that's the theoretical premise and foundation upon which this pure trend analysis rests. This is just a geometric application. It's something that Wells and Jim coined as the second reflection. It is just a rotation around a Cartesian coordinate system axis. All of these items here represent price points in the past. In quadrant 2, they are most probable. If this is the price action in the past, this vertical I forgot, it's the ordinate or the abscissa. One is the whatever, the vertical coordinate portion of the system marks or separates the past from the future. So quadrant 3 and 4 represent the future. But if you have any of this type of activity going on, and each one of these letters and dots represent, connected to a vector, represents a price level, let's say in the past. Given that price level, the second reflection, we've stated the second reflection is the market's own prediction of the highest probability of where it will go in the future, continuously updated. And so in accordance with what the previous slide was saying, if this is the activity, pure symmetry, which is the what you have when you have a trend, you have a system in this case, because it's a system because it has more than a single part and it's dynamic, it's in flux, it's not a stationary object. The second reflection, in other words, it's in a rotation around the vertical axis of 180 degrees, and then a subsequent rotation around the horizontal axis from bottom to top, and that will always put you in. If you start in the past in the second quadrant, you will always end up in the future in the third quadrant. If all of this price activity were occurring in quadrant 1, the most probable outcome, let's rotate this. The first reflection would have this situated. Let's see, if we're up here, it would end up 180 degree shift. It's going to be, it would be up in here. It would be, if all of this price activity in the past were occurring in quadrant 1, after the first reflection, it would end up in quadrant 3. By the way, the location and time and price, if that were the case, would be in quadrant 3 if all of this past historical price activity or price returns would be the second most probable price time location for the future. But I'm not interested in the second most likely, I'm interested in the first most likely. So the second rotation would mean 180 degrees around the horizontal axis, which would end up the future, so as to create that perfect symmetry in quadrant 4. So this is just a geometrical application of this analysis to show that it can be quantified and and more rigorously applied in the real world for practical purposes in actual trading. So I can generate a picture of the most probable and the second most probable trajectory or location from a perspective of time and price as to where a market will be in the future, utilizing this geometrical a set of rotations around these two axes based on, again, the first law of motion. So that, again, this is a little bit of the underpinning theoretically of this pure trend idea. Let's move on. Stock market, let's see if there are any. Thank you for the memory refresher. It's been a while since I, what was that, junior high or high school, whenever you took geometry or whatever it's called. The ideas of, remember, yeah, anyway. Thank you. Y is the abscissa and X is the ordinate. Okay, good. All right, so this is just an example. This is actually an old slide, folks, here. This is actually going back. I should have updated it. Don't worry, I will. This is, you know, if you were going to do a study on trend analysis and you pulled up any of the major texts, you know, Murphy, Schwager, McGee and Edwards, any Glenn Ring, any notable or suitable textbook on general trend analysis will have a chapter or chapters on pure trend analysis, and often they will incorporate an application of trend lines. The basic premise of trend line theory is it's a linear attempt to contain and graphically illustrate a nonlinear, and that's not actually perfectly precise. Financial market is an integration. It's a combination of both linear type of motion and change and nonlinear. So when the reason, and there's nothing mysterious, this is trend lines, if not the oldest, are probably in the top 3 most studied and applied and utilized forms of technical analysis going back probably at least 100 years, if not more. And the whole point is to try and contain and create a graphic boundary based on Newton's first law again, so as to, the idea being if you can get establish a trend line if it's rising with bottoms, if it's falling with tops, so that you establish a trend line with two bottoms in a period of time for which the net motion is up, and then then you extrapolate or project that trend line out. If it's met the third time, it's like over here, it's confirmed. That trend is confirmed. That's basic trend line analysis 101 that you might read about in an introductory text on TA, technical analysis. So that's just an attempt, and you can see the price action doesn't perfectly hue and glide and utilize that that linear instrument or graphic, but more or less it finds that linear graphic picture, i.e. the trend line, serves as what I refer to as an attractor of a very, very complicated system, a system for which there are times when it is more linear and the times when it is more closely approximating the more relatively simplistic behavior of the simple line. At other times it makes more extreme or a variable degree of excursion away from the modular simplification, i.e. the simple line. So a lot of all analysis, not just technical analysis, is an attempt to create a collection of ideas that serve to simplify and inordinately alter, other than that, in extremely complicated system. So that's one of the points of a general trend line theoretical premise. Just it provides a containment and a boundary condition for which we expect on a expectancy of persistency in accordance with the first law of motion, this system to follow. Something must, and let me just bring out a narrative for this. The reason I buy into this pure, pristine trend idea so strongly is, it's a very simple idea conceptually, and that is this. Nothing must happen in the world. Nothing must take place for, what is this? This is a stock index, S&P, back a few years ago. This is just a picture of the stock market motion in the United States. Nothing must happen in the world for this to stop doing what it's doing. Or stated differently, nothing must happen in the world for this to continue doing what it's doing. Excuse me. That's maybe more direct. Something must happen in the world external or surrounding this system. If we were to put this in a vacuum, if you will, and assume it's autonomous and is not impacted by anything, it would, in that theoretical setup, hypothetically, it would continue in accordance with the first law, a concept that governs every other physical principle, and in turn every economic principle, and in turn further down towards ground level, every financial concept that I am aware of. Nothing, if this is unaffected by any external force, all things being considered, this system, in this case it's just a picture of the stock market, will continue moving in doing what that's perfect symmetry. Symmetry is continuance. Why, by the way, might that be the case? It's the level, it's the state in which there is the least amount of expenditure of energy. So think of it from a standpoint, if we want to really look beyond that as to why, it's survival. Everything, organic and inorganic, live and animate or inanimate, there is this implicit need for survival. The financial market has a need, whether we understand it or not, to keep surviving. The state that allows or increases its chances most greatly for that is to continue doing what it's doing. Why? Because that's the state that requires the least amount of energy. Your conservation of energy. This is an energetic concept as to why it works. If in understanding a little more deeply, for those of you who are less interested in the theory, more interested in the practical benefit, I told someone just a few days ago, I can enjoy the benefits of television without understanding the intricacies of a cathode ray tube and the electronics of dispersion of various particles hitting phosphors on a screen, or LED, or whatever the technology is today. On the one hand, from a trading perspective, I was making the point, there is some energy, I think, or something to be said for the idea that, to the extent, because there is such an emotional component in trading, to the extent I have more of an explicit comprehension and understanding as to why and how a particular model or set of ideas or an indicator works, I have more confidence in a consistent application of that concept. I can either be agnostic and trust in the results, and or I could choose to, as a contingency for my application and utilizing of an idea, seek a deeper understanding as to why. To the extent I have confidence and understanding as to how a system works, I am more inclined to apply it. I might be disinclined if I am don't have any, if it's black box in a sense. But in any case, this is just a graphic picture of stock market persistence. Let's move on. Trend or change. This is the same graph, but I've introduced, I'm not going into the details. This is a circle, obviously. Circles there are three geometric shapes that I use in some of the more complicated forms of analysis that have to do with forecasting. One is a circle is the most important geometric shape I would submit, not only for technical analysis, but for everything in this universe. Circles, squares, and triangles, in that order. All right, but at least the circle is number one. I'm not sure which is more important, the square or the triangle, but all three are important. One of the applications, the application of a circle here enables me to project in various ways both price and time turning points. As it did here, you can see I projected the boundary of this circle, and it tells me different things, when a market's going to turn and at what price. Okay, so that's a conflict. That immediately now I'm shifting paradigm. I'm shifting from pure Zen following mode, being completely ignorant about the system, just monitoring and following and grabbing onto the coattails of this dynamic system without the need to understand its intrinsic complexities, just go along for the ride. Okay, that's one compartment of thought, and as long as that this trend line holds, or as the persistency maintains, I'm probably going to optimize my return. On the one hand, the complete opposite paradigm, I introduce a technique of complexity in order to project. I move from following thought or a state of follow to a state of attempting to anticipate, because I've introduced a system or a relationship that will, to some extent, hopefully if it's effective and accurate, generate new information that's insightful to me. It gives me some additional knowledge. I move from my complete ignorant state to a state of relative enlightenment. I learn something about the market, I make a projection, and I forecast the market's going to turn at such and such a date at such and such a price. And if I have confidence in that, if I have sufficient evidence to suggest I ought to have a modicum of confidence, I could get positioned in a manner that would exploit that. So trend or change is the kind of, I'm oscillating or vacillating between those two thoughts based on the two paradigms of analysis. Interest rate persistency, just a bond chart, same idea, the linear trend line showing the degree and the amount of time, the segment of period market motion for which that theoretical premise was pushing the market. Trend or change, a series of these more complex ideas to indicate points in change. Which idea do I follow? Simple, this is just a spot pair currencies, same idea. Notice the duration for which this thing hewed. Why do markets spend so much time once they get on board a given move up or down? Because again, from an energy standpoint, that's the type of market behavior or phenomena that requires the least amount of energy. For a turn to occur, anytime you see a top like this right here or a bottom on a price chart, most traders, based on our accumulated understanding of very interesting, esoteric, convoluted relationships, ideas, models, etc., that facilitate, when they work, a forecast of when a market's going to turn or change, most of us begin to think and view of tops and bottoms as a normal event. They're ubiquitous. Any chart, any market, any freely traded financial market on any time frame, stocks, bonds, commodities, you name it, on any time frame, a 60-second chart, a tick chart, to a quarterly chart showing or a yearly chart showing the history of a market's motion since its inception, and every time window in between. We get so accustomed to looking at these things, we begin to internalize top and bottom formation as the norm. And that's a logical consequence of the analytical forecasting paradigm. All right? Are we still, can you guys still hear me? Let's see. Okay. Yeah, someone's asking, you can get a link. Sound is okay, yes, you can. All right, you have the opposite paradigm. Every time I see a top such as this, or a bottom on this chart, or this bottom here, this long candle here, okay, the hammer or whatever it is, we recognize a top or a bottom as an extraordinary event because something had to happen in the world external to this, what is this, dollar Swiss currency pair, in order to make that happen, or enable the market to stop trending in a given direction and start to trend in an alternate direction. Unless and until a given event or series of events in the world external to the financial market. By the way, talking in normal speak, you regular people on the street and you and I, even as traders, we refer to these as events, fundamentals. They are market and sector specific, and they can get even more specific. If I'm talking about an energy market, say crude oil, it might be a news release or a press conference concerning an event in the Mideast, or maybe even more specific, it's a pronouncement by OPEC. Or maybe more specific, it's the API report by the U.S. government concerning levels or reserve levels of oil in different regions of the country, what they call PADs. It might be demand, for gasoline is seasonally going to rise as we approach or move into the spring or driving season. It might be a weather-related, soil moisture content has increased as indicated by surveys performed by the USDA in planting regions, and that could, in certain ways, impact planting and yields, which in turn affects supply, which in turn affects the supply-demand ratio, which in turn affects and impacts price of soybeans or corn or wheat or sorghum or whatever. It might be an earnings report of a stock that came in greater than expected, as expected, or less than expected. It might be a pronouncement by the chairman of the Fed concerning their current thoughts as to when they're going to raise interest rates. It might be an actual action by our central bank in cahoots with with the Bank of Japan or the Bank of England or European Central Bank, where we're going to sell dollars and buy yen, or vice versa, in order to affect some regime change globally in the currency sector and the economic sectors on down. All of those types of things that the pundits talk about on the financial networks, that we hear about in the news channels, in media and tracks day in and day out, are merely what I refer to facetiously as containers of information. If the information is of the right quality and of the right frequency, frequency connotes energy. The higher the frequency, the greater the energy. Unless and until all of those conditions are met, this dollar Swiss currency pair is going to keep, if both of those things are not met, in other words, if the particular type of information that's brought to this system somehow, some way, by virtue of in 2015 we have all sorts of technological delivery channels or aqueducts, if you will, that to which and allow for an communication between the world external to this very complicated system we call dollar Swiss and the world surrounding it. If it doesn't have or bring to bear on this system the right type of information from a quality standpoint and doesn't impute enough energy, this thing has no choice. If without sufficient energy, it must do what the least amount of energy that it has internal enables it to do. That is what? Keep doing what it's doing. Unless and until something impacts and creates an internal thrust sufficient to enable this thing to stop doing one thing, it will remain on that track as a consequential respect or deference to the first law of motion. The only reason a market turns is because something or things in the world facilitated the change, the turn. So as such, I said all that to say this. Whenever I look at a price chart of a market, the pure trend analysis paradigm or philosophy that paints and creates the particular lens through which I see this market says, view that top or bottom on that screen as an extraordinary event because it signifies some type of energy. However, whatever the fundamental event that, from that perspective would characterize it as, something allowed and facilitated an amount of energy sufficient to get this very complicated dynamic system off of one track and onto a completely different track. Without it, that top or bottom could not have formed. It would have maintained its preceding track in accordance with that first law, because that's all it can do energetically. It doesn't have enough gas in the tank to enable it to do anything else. It's stuck in accordance with that first principle. So that ought to allow, this paints my entire thought backdrop or stage by which I begin to look for a good trade. Let me progress this. Same thing, Forex persistency, utilizing this linear model. There are going to be points when the market more closely used. Look how close that did for such a long period of time. Made a greater degree of excursion, reverts back to the attractor that serves as the track upon which this system is guided. Linear extrapolation. Saying this is coffee. That was that previous slide. What is this? Japanese yen. That's a financial. Here's an agricultural or a food stuff. Look at it. One touch. If we're talking about a falling market, the traditional way connecting tops. You have one top. You have this confirmed, this top here, more or less, barring that little overflight of inertia here. That's confirmed. That creates the trend line. This the third touch of a top confirms it. And a more confirm here, more confirmation here, moving right to. There are periods of time for which the nonlinear type of forces and vectors cause the market to deviate, and then it returns and approaches that track. This is the guidance. This line here is a simplification of an otherwise impenetrably complicated system, and it provides a graphic cue to make life easier for us. If I didn't have that, I can still do this, and I'll show you how in its three steps by the end of today's presentation. That's coffee. That's an whole slide. This is same thing, showing, going back. This is attempting to forecast. This goes through September, October. Here's the future. Here's September, October. Notice it touched on that graphic and bounced off. It's saying continuing in the same direction. Oh, this is up through, this is the point of contact moving in strictly according to that track. Here is, again, continuing to do what it does. Why? Nothing's happened in the world external to this to enable it to start doing anything other than this. So what does it do by default? It continues doing the thing that requires the least amount of energy flow, whatever that is. Always. That will always be the case. Turning point triggers, external force, fundamental events. Okay, are there some, so when we see a top or a bottom on a chart, understand implicitly that there are things in the world, we call them fundamentals, you can call them whatever you want. They are containers of energy. Okay, I submit there are times and place, this, and by the way, this is in strict accordance with an aspect of the first law of motion. Let me repeat, what did Newton say? A body in motion or a body at rest will remain at motion or at rest unless and until otherwise acted upon by an outside force. That's a verbal explanation. He did it with a series of symbols mathematically. Nevertheless, same idea. Gann realized this. He said, when time and price balance, the market will turn. That's a market speak way to say what Newton said many hundreds of years before Gann. Gann said this in the early 1900s. He was merely citing a particular aspect of the first law of motion. That's which aspect? Unless and until acted upon by some outside force. The outside force manifests when price and time meet up. What someone like Newton or Einstein would say when when space taking the place of price. One and the same thing. Same underlying, different underlying phenomena, but more generally one and the same thing. Space, price. What goes on in space, in our case, from the perspective of trading, is simply price changes. That's a phenomena that can occur with mass. Same concept, just applying it to a different particular system. When these things get into balance, what are some things that I use? It really, and I present this slide merely as an example. It really doesn't matter. You know, there are some traders out there in the broader concept of instructing and having us learn about what it takes to be successful as an investor that will tell you, and I to some extent buy into this. It's not, you know, remember, it's not purely analysis that is sufficient. Not analysis, however fine-tuned and precise and accurate it is, however, you know, whatever it is, however good it is not sufficient to greatly guarantee your success. You've got to have good capital allocation rules and shifts, how to work your money, and trading psychology. Those are the three spokes of the wheel I always tell people. And those of you who've heard me talk before know, in the bigger sense, this is why I think so many traders are not successful. We spend most of our time, and as we should, initially at least, you've got to build your foundation. You have to understand the mechanics of the system you're interfacing and working with and dealing with day to day. But to assume that alone, that's just one branch, one spoke of a tri-spoked wheel. You've got to know how to actually apply these ideas, and this is where the capital allocation or money management rules come into play. But here I'm saying this, there are people like, for example, to make an extreme, Dr. Van Tharp, people who write extensively and research issues, you know, based on Kelly formulations and so forth about money management that say, you know, trading is a probabilistic enterprise, which it is. And as such, however mediocre or however fine one's analysis is, it really doesn't matter. I understand that, you know, that's an extreme way of putting it. I would tend to state it differently. And I understand that you want to make a point. I'm not suggesting one purposely not develop the capacity to which they can improve their performance ratio, that is the win-loss ratio. You certainly want to do that. I'm saying to the extent you are going to fall short of perfection in however good a win-loss rate, you know, if your win-loss ratio is not as good as you'd like, there's still hope. In other words, so I'm saying it doesn't really matter what are the components and the ingredients of your analytical modules that you generate. It might, I think there are differences, but not to the point, that's not the sole factor. If it were, then it would mean that, yeah, there are explicit, very, very definitive differences between what are the components that you use. Do you depend on divergence? Do you depend on candlesticks? Do you depend on Murray math? Do you depend on geometric, you know, numerical relationships? Whatever you do. So I am merely pointing out some things that I have found to work for me. Oscillator divergence is one. Classical or candlestick reversal patterns. I know a lot of people. I don't personally focus on those myself that much now. At the beginning of my career, I did. But I cite it because I just to make an example. Fibonacci and or harmonic retracement levels. I do incorporate those extensively. Multiple Elliott wave embeddings. I certainly depend on that. I think Elliott is a very powerful descriptive model, even though it's not perfect. Cycle period endings. That cycle period endings probably typifies my area of where I've spent the most time trying to investigate. In terms of the alternate regime, that is not the pure trend following methodology or paradigm, but rather in my attempts to anticipate when and where. Specifically with cycle period endings, it refers to the when, the time component, in deference to the concept that Gann was talking about. A market's going to make its move or do what it's going to do once its time has come. And cyclical analysis basically is referring to that precisely. So this is just a small representative list of types of technical phenomena that can often, either singularly but more typically, more likely in aggregate, serve to indicate that it's time to make that shift from following paradigm or regime to anticipation. When I have a preponderance of any one of these things or similar types of events, technically. Now, if you're a fundamental trader It might be when you have an aggregate of fundamental events, any one of which by themselves may be insufficient, but when you combine them are sufficient to turn a market. They impute the energy requirement to overcome the current mode or vector of motion and shift to a different, or there's an acceleration or a deceleration, meaning there's a change in the vector type of velocity for that system. It stops going up and starts to come down, or vice versa, to make it plain. So when you have something, when you see this, that's an indication it's time, more likely, on the continuum of odds, to shift your mindset out of following mode to anticipation mode. So here's an example. End of persistency. You can see for this period from the bottom, this is the dollar versus the yen. It's just a picture of the dollar stated in yen terms, a cash currency chart. It's going up. Dollar's rising. And then I see an example of one of the items listed on the previous slide. I've got divergence. This is a standard, what is it, stochastic down here. A market formed a top, market went to a higher top, same stretch of time, oscillator formed a top, lower top, divergence, and then you have an expectancy for, that tends to correlate more probably with a change. For whatever reason, the purpose of this webinar is not to go into the reasons of each of these models, but there is a correlation. I may not understand the cause and effect, or the cause and effect. I can understand the correlation, though. If I can understand the cause and effect, it's always good to have as much information as possible, if it can. But even barring that, at least recognize correlation. Okay, so that's an example. And another possible trend transition. This is an RSI, 14-period RSI, based on work that George Lane did many years ago. I developed about 10 years ago a model that enables me to more definitively, it's not the only idea, it's one idea I came up with by which, if you can see from left to right, natural gas chart, this is an old chart, hitting this bottom right here, and then when it hit the bottom, it starts going up. It consciously or unconsciously, whether you know it or not as a trader, and this is just an example, anytime a market reaches a terminal point and starts moving in the alternate direction, the question will arise in your thinking. What to make of that counter move? Is it just a temporary retracement? In a case where a market's been dropping for a period of time and all of a sudden goes up, what we could refer to as a rally, a bear market rally, or ought you place greater significance and attach more importance to this bottom? Does it mark the end of a generic bear, possibly the commensurate onset of a new generic bull? Is it a bona fide sea change, or is it just a temporary a rally within the bear, a type of activity from which you can add to existing shorts at a more optimal price level, or establish a new short? Which one is it? That's the point where we transition from theory to real world, where the rubber meets the road, as they say. Well, over the years, all sorts of ideas have been developed. I came up with an idea. When you see this, when the RSI crosses above 65, more likely it correlates with a transitioning. If it, in retrospect, however, until that point, when the market, after hitting this bottom, starts moving up, however high it moves, if it hasn't moved high enough to cause the RSI, a 14-period RSI, to cross above 65, I'm thinking of this price rise as just a rally. Once the market rises far enough away from this bottom, sufficient to cause the RSI to take out 65, that's an indication more likely I ought to rethink, redefine, recategorize this price action as a new bull market. And I have a similar idea. If a market's been going up and hits a top and starts coming down, at what point do you think it's the end of the bull, start of a new bear, versus is it just a temporary pullback in a bull? Well, when the market falls, however far it drops, if it falls insufficient to cause the RSI to drop below 40, it's probably just a temporary pullback, and still I characterize the trend as a bull market. If the market continues its decline, however far it drops, once it's dropped far enough to cause the RSI to drop below 40, that more strongly correlates with a new bear market. So that's a model that was developed to try and enable traders to anticipate how to characterize and in turn trade so that they can acquire edge. More complexity there. You got to think about it. You have to take into account and conceptualize and apply certain relationships, as opposed to the alternate, pristine, pure, just following. Let the market decide. Can I sit back, observe, wait till a change occurs, and get on board, and work on the assumption of persistency in accordance with that first law of motion? Okay, these are two opposing ideas. Well, which one is better? they're two different sides of a similar coin. Point of decision, same idea. You can see for a long period of time, markets coming down, stay on board that wave. You can see, and then until you see indications of whatever they may be. I just listed in 2-3 slides back a set of things for me that they make sense. It could be oscillator divergence as indicated in this slide. You have a bottom here, lower bottom. On your oscillator, same bottom here, lower bottom here as you would expect. Lower bottom in price, higher bottom in oscillator, classic divergence, any textbook. That might be one relationship in terms of the behavioral change in the price system you're studying with respect to the oscillator you're using essentially to try and gain and glean some information concerning its future state correlated with a more probable change of direction, a reversal. If that in combination with other factors suggest you should make a change, that is your point that you begin to shift out of follow mode into anticipate mode. And you watch and wait for the change to occur, if it does. And then you loop back in that feedback type of way in accordance with that earlier slide to one of following on an assumption until you get an accumulation of evidence again indicating a change. Same thing, old trend or new trend. Make new friends, keep the old, one is silver, one is gold. I was saying that in kindergarten, I think. Same thing, just indicating a slide. You had the persistency graphically indicated by the trend line, and then you all of a sudden I have tools that come in. It's not important the specificity of the nature of these tools. That's what we teach and what others, you can read this and learn this. It may vary from one trader to another. What's important are the two, we understand there are two discrete paradigms at work. You're either going to follow one or the other, or you can, if you are able, in the manner that I'm suggesting, create a compartmentalization in your mind, in your thought stream. One hemisphere of your thought is slated to apply the wait and watch and follow, unless and until you see this aggregate of information that says it's more probable, there's a high enough correlation where we've passed the threshold where it's more likely enough energy has been imputed to this financial system to enable it to get off one track and move on an altogether separate and different track. Wait for that shift to occur. It will manifest as a top or a bottom on your price chart. Once that occurs, shift back, you feed back to follow mode, pristine trend. Ride that wave for as long as you can. That's how you maximize your financial return. This is a chart, this is fast forwarding to the present. Printed this out yesterday. I was reading an article, let me just see, are there any questions here? Anything? I think, all right, hopefully, yeah, I'm seeing all sound, okay, sound is returned. Okay, I'm assuming, get my feedback on my indicators, looks like everything is fine. This is reading an article yesterday on Bitcoins and correlating and just interesting phenomenon and to what extent the Bitcoin market is affected by the events in Greece and China and Shanghai Stock Exchange and all the different, it's fundamental. Nevertheless, I was just interested seeing what's going on, and I'm always interested in intermarket analysis from, if I'm more focused on certain fundamentals. But this is the US dollar, long term. This goes back to this is like 80s, or wait a minute, how far is this? It's more than 20 years. This is a long-term US dollar chart. So you can see from this top back here in wow, this is at least 20 years. It's 1984 all the way to the present. And this, you can see the linear trend line. You can see it made an extreme excursion from that linear type motion. But nevertheless, endpoint to endpoint, the net translation is down in the US currency. If that's your time window, 30 years or so, you see. And then these color lines are exponential moving averages. The blue line is a 50. The let's see, the red line is 100, and the green line is a 200. Fund managers and hedge funds utilize crosses of like the 50 with the 100 and the 50 and the 200, or the 100 and 200, etc., to indicate capital flows. Should I be shifting to cash? Should I be shifting out of into paper assets, etc.? For more macro type portfolio shifts and adjustments, you might follow a moving average crossover type system. I've actually utilized and teach a moving average system to enable beginning traders to kind of acquire more of an intuitive sense as to how to think about trend. It's kind of like, I won't say a crutch, it is a training wheel by analogy, set of apparatus by which once you have gotten accustomed to, at some point you don't need the moving averages. But there's nothing wrong with the moving averages. The moving averages respond to the price activity, not the other way around. Sometimes we get so enamored with a particular technical study, that's our laziness probably. Who was it? Jim Sloman and others. He's not the only one, but he told me many years ago, the best indicator ever developed is the market itself. Allow the market to be its own best arbiter of where and how it's most likely going to move, and it adjusts. And again, that's a kind of a distillation to some extent of what people like, implicitly what Isaac Newton was saying and what Gann internalized as well, and people like him. Okay, so this is just a graphic. This is the linearization of a system that's much more complicated than a purely Newtonian system, but we attempt to kind of enable us to work and manage and manipulate very, very complicated systems. We utilize very relatively simplistic systems, and to some extent that allows us to grasp more information than we would otherwise be able to understand about that complicated system by using a very simplistic linear tool to apprehend and study a system which has components of linear motion, but at the same time integrated or mixed with nonlinear, imputing a lot of its complexity. So you can see right in here at the bottom here, again, the blue line is your 50. That's your short-term exponential moving average. When it crosses up above the 100, that's an indication. It's kind of, now, moving averages are always following indicators by definition. The lag time of any moving average, and now this is not quite, because these are adjusted exponentially, but a simple moving average's lag time is always half the period. So it's always going to be, the phenomenon, the moving average, will always occur an amount of time after the actual market phenomena that's responsible for it. It's always by definition. That's the ongoing critique of moving average technology. It is what it is, but that's the price we pay. The benefit we derive by using a moving average is it slows the data and enables us to see behavioral attributes that we might otherwise not see. So there's always an exchange of, we pay something, we get something in return, quid pro quo. All right. So this is the US dollar. So what's important relative to what's coming up in the next slide, I want you to see this crossover confirms the move. That's one form of analysis in complexity in an effort to confirm that in fact a turn has occurred. Notice we've been going up since, kind of in 2014. For the last year, we have essentially, the US dollar has been appreciating. If you just looked at a chart of the year, you would think the dollar is the strongest thing since, it's taken off like a rocket. You put it in, this is why it's always good to look at big pictures, put it in the context, if you hadn't known. But certainly, clearly for the last year, we've been seeing tremendous relative strength in the US. And they're talking about, the article was talking about the US dollar effect on Bitcoin fluctuation. Okay, next slide. If I can get there, let's see. So this is a more recent near-term persistency. Is the USD ready to move higher? The positive economic numbers out of the US continue to suggest a rate increase will occur before year's end. Well, for those of you who follow financial sector markets, stock market, bond market in particular, one of the major event fundamentally has, every month with every release of any and all economic reports, unemployment report, consumer confidence, all of these things, beige book, all of the indicators and reports that stem from our government's attempt to monitor the U.S. economy, its current state, the degree of GDP, inflation, all of these things that are registrations, if you will, of our economic system and our response to them in terms of, and what's been the big news for the last 6 months? When, if and when, and to what extent we're going to raise interest rates, the cost of money, essentially. And so Janet Yellen basically has been saying for months now, well, we're going to allow our decision on this to be data-driven, as I think is appropriate. But so this is, you can see overall, this is, here we're not using a trend line, but more or less these moving averages serve as more of a flexible. They're a little refinement of the pure linear trendline tool. They're a more closer approximation, if you will, to the actual system. It's so complex, but still not as complex as that. So that allows us, by virtue of the behavior of a single moving average and or a set of averages, to kind of more finely discern and anticipate the future course of motion. So one of the little tricks that analysis, I mean, it's very simple, it's very facile, you know, a crossover. When a faster average crossing through a slower indicates that the market's going to move, or more likely going to move, or it confirms the move of the market in the direction of the cross. Oh, very, very simple idea, but it is on the realm of anticipation. Has nothing to do, but in terms of, it's less arbitrary. The beauty of the trend following approach is it's completely non-arbitrary. The critique, if you will, theoretically, of the anticipatory or forecasting paradigm is it's completely arbitrary. Meaning, not one is not negative or positive. They just have attributes that are foreign one to another. They are completely, again, polar opposite forms of analysis. This is contained, or the fact that, all right, let me read this again. The positive economic numbers out of the U.S. continue to suggest, okay, because so for the last few months, we're getting some positive data. You know, more people may be back to work or whatever. This is just, that's not the point. But this report is saying that the data that is is suggesting that maybe the economy is moving out of a recession, we're maybe getting some signs of life, would suggest to buoy the dollar long enough with global economic uncertainty, particularly out of the Eurozone. Okay, that would be a negative type of thing. You know, if there's uncertainty, you know, to the extent the deal with the IMF and the European Central Bank and European Union breaks down with Greece, that might be, you know, well, I'm not sure how the U.S. dollar might interpret it. It might ostensibly on the surface, a very basic interpretation might be weak because, you know, investments in Europe, basically, this is all fundamental. But it would be strong to the Bitcoin. Dollar goes down, Bitcoin and commodities in general will strengthen. Dollar goes up and it puts pressure on an alternative currency like Bitcoin, the Bitcoin market, and or general commodities, oil, let's say, or general commodity price tendencies. Okay, so this is just a more recent trend. So here's the idea. Okay, and a final slide. This is just, I printed this out yesterday as well. Kiwi, or New Zealand dollar, it's going down. Okay, so it didn't take me but it didn't take a nanosecond, a peak, whatever, the smallest amount of time elapsed to see that visually, for my retinal visual apparatus to pick up on that. Here's the process. How simple this is. Don't let the obvious simplicity fool you into thinking it is not sound and robust and accurate. And I know how that could be. Typically, things that tend to be reliable and accurate tend to be implicitly contain a degree of complexity on par with the system to which they are applied. Very often that's the case, but not always. In this case, because it's the reason this is such a simple form of a simplistic, ultra simplistic form of analysis is because it took an insight that changed our realm hundreds of years ago by Newton. It is so utterly startling. The consequence of it, all the complexity was contained in this monumental insight. It boggles my mind. But anyway, I don't want to get off on that. I'm simply saying the reason this is so simple is because all the legwork was done primarily by one Newton, and he did all the however it came to him to understand this concept. Here's the process practically. Find a system that's in motion. The higher the velocity, the motion, the more likely it will persist. Let me repeat that. The greater the velocity, the more of opposing vectors or forces, things like candle formations that correlate with a reversal, things like a cyclical ending point. You've reached the end of the cycle period. That means, what does that mean? Market must change its type of behavior. Or a Elliott wave has completed, marking the onset of the next wave in the sequence in the opposite direction. or there is divergence between the type of price action you're seeing and a particular oscillator you're using, or there is a pivot point, R1 level that the market has achieved that time that you read in some textbook or somebody taught you correlates with a change in trend, or the market runs into a Fibonacci 50% fib level, or 60, or whatever it is, 61.8 level, and 67% of the time when that happens, the market shifts. Or there are 2 or 3 of these things acting in concert, which when you've seen 73% of the time in the past for that market, the market changes, and you take on that amount of confidence and you go enter a position in accordance with it in an attempt to profit. I am saying all of that. I'm saying it will have to be, even if you have all of that, the faster this thing is moving down, this is key, or New Zealand, US, or US, the faster it's moving down, the more likely it will continue to move down. So as a means of selecting your best trades, find a market or look at a chart that is a graphic representation of a market's motion from any given amount of time you choose to select, going backwards in the past, its inception marking the ultimate starting point, through the present, or whatever segment you choose. And if you are looking for the best trade, compare it to another set of charts of other markets. The best candidate for your money is the market that's moving the fastest. How do you know? How can one discern the relative velocity of one market versus another? Slope. This is what I teach practically. I'm just giving a quick synopsis of how you can literally select trades with this ultra pristine and simplistic trend approach. Again, you're looking for a system already in motion. How is it in motion? Visually inspect a chart. It's either going one of 3 things on a 2-dimensional surface, a chart: up, down, or sideways. Eliminating a market that's going sideways, you narrow down your candidate pool list. Only focus on the ones that are going up or down. How do you narrow it down further? I've only got X amount of capital or equity. I can only do one market. Pick the one that's moving the fastest. How do I know? The one that's moving with the steepest slope on a 2-dimensional surface, which is your screen. Or in the old days, 30 years ago when I started, everything was on paper, a paper chart. Doesn't matter. It's a 2-dimensional plane, 2-dimensional coordinate system. That's all. The steepest slope, what's the steepest slope of all possible? A vertical line. I'm fond of telling people, rarely do I see a chart going straight up or straight down. If I do or did, that would be all of the variables iced or fixed for the moment, and I am operating in a vacuum. That's my numero uno choice, bar none. Why? Because that's the market's way of telling you, broadcasting in market speak to the world of onlookers like you and me that are trying to discern what's going on and get some edge somehow. That's what it wants to do. From an energetic standpoint, from the context of energy, this thing is saying this is its path of least resistance. This is the trajectory, the direction, the type of action it's engaging in that requires the least amount of energy expenditure. Anything else is going to take an input of energy. I'm not saying that won't ever occur. History tells us it will from time to time. I know there's a registration of that every time I look at a price chart and I see a top or a bottom form. I am simply saying I perceive those tops and bottoms as an extra. That's the system pulling into the fill-up pump station. Because it's run out of energy, it needs a new influx. It needs to be its tank filled up, if you will, so it can progress either in the same direction with a renewed amount of life, or in an alternate direction. It's pulled over for a pit stop. Barring that pulling over for a pit stop, in a figurative way of saying it, what happens in the real world, it doesn't actually pull over. It is impacted. It is bombarded with some type of information. If it's a currency, it might be a financial event in European, in the European market concerning the Greek drachma, whether they're going to return Greece will return to the drachma, or are they going to remain on the euro? Or if it's a financial commodity like oil, a report of tensions in the Mideast, missiles flying in the Persian Gulf, and so collectively traders worldwide say, aha, that could possibly impede the flow of oil out of the tankers in the Persian Gulf. That could hold up oil supplies. Given a certain amount of anticipated demand, what's that going to mean? Rising prices, war, missiles, tensions between Iran and Israel. What's going to happen? Price of oil is going to fall. or an accord reached between Israel and Iran or Iraq or whatever, and oil is going to flow freely, and demand is decreasing globally, and the global economic demand is going down, oil is going to plummet. More supply, less demand, plummeting prices. Let me make money on this. So I'm either happy with my current short position, or immediately Monday morning I go in and sell. Multiply that phenomena times the tens of thousands, if not millions of participants worldwide, you create persistency of motion. And unless and until something happens of the right type and of the right frequency, frequency being equivalent more or less to energy, the system is going to maintain that track. Why? That's its path of least, that requires the least amount of work and therefore the least amount of energy. That's all. It's an energy consideration. From a practical note, I think we're approaching the end of this session. Here is a trade that I will, if you haven't, I recommended this to some people yesterday, well, for the last 3 days. Gold. This is printed out yesterday. Okay? What's the system doing from left to right, albeit in a very complicated way, bouncing all over the place, but more or less from left to right. To simplify this, it's going down. So my trend following model, that paradigm, that philosophy, that mode of analysis tells me go short. Because again, in principle, I can, to the extent you can maximize the amount of time that you, or your positions rather, are in direct strict alignment with the trend, is the extent to which you will maximize your percentage financial return on your investment, period. So if you want to filter this, okay, you find a system that's going down. If you're satisfied it's going down at a high enough velocity, that is at a steep enough slope, it qualifies as a potential candidate. Here's the final filter, very simple, sell below support. So I told people as early as 3 days ago, Wednesday, we break down below, either if you're conservative or semi-conservative, below, close below this bottom right here in the middle of the chart, whenever that, I forgot the date on that. A close below that if you're, a little aggressive but more conservative, you want to wait for the market to prove itself. If you're extremely conservative, this deeper, more important, wait for a close below this. Notice what happened yesterday. So if you're not already short, this is the market, this is the trade of the week. Do that Monday. You have a very high probability of adding equity to your account. Until, now this is this is some of the analysis that I do. You may do something else. This is what differentiates one market participant from another, one trader or an investor from another. I have about 80% reliability in my, historically, in my repertoire that enables me to project when a market's going to turn. The next time target I have projected, for which I have that amount of confidence, 80%, July 31st, in gold, specific to the gold market, is the next turn point. So, all things being equal, rarely is this the case, I anticipate gold prices to drop into the point, for how long? What's the potential projected runtime theory that my complicated analysis has worked up for me? Between today, which is July 18th, or let's say the market's not open today, yesterday, and 7/31. That's exactly 2 weeks. So I have a little more information. I'm moving on the continuum of degrees of knowledge from a state of pure ignorance to a state of more incrementally increasing my degree of understanding. That's what the anticipatory paradigm has. It informs us, whereas the following paradigm, we're ignorant. And we constantly vacillate to the extent I have a sign of information. So as the market moves closer and closer, and I anticipate it will continue to drop into, for how long, this is not a price, I don't know, a different form of analysis will enable me to tell you where it's going to go from a space standpoint or a price/space standpoint. This type of analysis tells me how long it's going to go. July 31st, 2 weeks from today. That's the runtime. And then I'll get out of my short and in a simplistic, all other factors being iced again or it's fixed, go long. For how long? Till the next turning point based on my analysis. September, curious date, 9/11. So that's an example of how I would actually do this in a simplified way for the purposes of our presentation this morning. That's a trade you do right now if you haven't done it, because I did that for some people that I talked to in the last 3 days. Okay, here's a trade about to happen, exercising a similar concept. What is this? Crude oil. Previous chart, oil. This is another trade in oil. What is it doing? Left to right, it's going down. What is it therefore more likely to do based on the simple trend pure paradigm? Go down. Why? Because that's the thing that nothing has to happen in the world for this system, for this very complicated system that we talk about. Strategically, you could make the case that oil is the most important commodity on Earth. The entire world revolves on oil. What is it likely to do? Someone asks you, what are your prospects? What are your projections for oil prices? It's going down. Why? Because that's what it's been doing based on the first law of motion. How long do I anticipate that? I couldn't work, based on the structure of this chart, I have not yet been able to work out a date in the future, the runtime. What I do know, these are some historical times. 6-1, curiously enough, the last OPEC meeting, June 5th, that was one and the same data point. 7-14 that came in a couple of days ago. For those of you who know Elliott, this is the start of a wave down. This is 1, 2, this is your 3, this is classic 4, and I think we are beginning a 5th wave. I know that. You might know that seeing what I just covered and saying that. You might have known it if I hadn't said it. Doesn't matter. If you didn't know that, but you understand, even if you buy into even if you don't understand the first law of motion, if you understand that whatever a system is doing, whatever a financial market's doing, it's most likely going to do it until something keeps it from doing it or enables it to do something else. So even though I have yet to project out into the future when I expect the market to change again, I can and by the way, I can do that. I just didn't have, this chart, the structure and the price action of what I'm seeing, it's not, I have a date that I've worked out, 10/6 is tentative, October 6th, but that's far out. I don't know, I don't expect, I have other factors that would suggest the runtime. I don't know that the market's going to keep going. I don't know that it's not, but I do have a tentative date of 10/6, October 6th. That's a lot of time between now and then. But it is a tentative date that I've worked out. I worked that out last night for oil, specific to oil. Typically 5th waves, if this is a 5th wave, but regardless if whether it is or isn't is irrelevant in the context of this pure trend analysis. But that's a tentative trade. If you want to filter it, is it going down? If you like the velocity, that is the slope with which it's going down, then it represents a viable candidate for your establishing a position. If you want to be conservative and filter it, what's your rule of thumb? Sell below support. Where is a relative support? Look at this bottom right here, which is essentially this bottom right here, which is more or less this bottom, but at least these two bottoms. If you're more conservative as a trader, require a close below this bottom here before you establish your short position. If you're more aggressive as a trader, sell it right now and then establish your zone of overhead resistance of where you get out if it starts to see price action anti to your position. Okay, that's a trade possibly coming up this week. All right. Folks, we're at the end. This is just, this is specific to the stock market in the U.S. This is just a list of past and future turning points that my cyclical analysis or the whole cadre or spectrum of tools that I utilize to project time targets has generated. So this is for the stock market. Again, this data, these dates are past time points that I have projected for stocks. I personally trade the E-mini. And by the way, I do all types of trading, short-term, long-term. I day trade the E-mini. In 30 years, I've done everything. The only thing I don't teach in the context of my work in consulting, I don't currently focus and teach primarily with a focus on fundamental analysis. An interesting irony I always tell people is I started my career, the very first book I read was Fundamental Analysis by Benjamin Graham. It's the Bible of the fundamentals. Not that I can't, it's just that I'm not set up infrastructurally to do that. I am not pro or con fundamentals. Information, these are whether you want to seizes the fundamental approach, technical, quantitative, they're just labels to provide context of conversation. I think in the world today, at least from when we're focused on the analysis part of this business, the best of all results is typically derived by an amalgam of all of these things when different types of information due to their intrinsic differences and in spite of those intrinsic differences from time to time move into nexus and convergence and align, that's a stronger indication that as a feedback that you're probably pursuing analytically or you're moving down a correct path. It tends to correlate with higher probability. What are the odds of any given form of analysis or relationship that you unlock and see and uncover being wrong? Well, it is what it is. The odds of three or a multiple of very different relationships, which in spite of their differences happen to lead you to the similar output of conclusion, it's less likely that all of those things are simultaneously wrong in the same way. It's correspondingly more likely they are pointing you in the right direction. So that is a premise of theoretical, all technicians and traders probably agree with more or less. Kind of one of my coworkers was fond of saying, what's the sound of one hand clapping? To make the point, the combination and the integration of varying forms of analysis typically will serve you well analytically. So again, for the stock market, I've been long from basis the September S&P. For those of you who are from a practical standpoint interested, 2058. I think we closed yesterday at around 2120 area. I think we got up as high as 2120. We might have settled 2118. We got resistance coming in on the May 19th top around 2126. Just for those of you who are interested in some details on the stocks and trading, yeah, I'm long from 2058, 2058 basis the September S&P. We break above the May 19th or May 20th high, depending on which particular index you're following, which again is on average about 2126. The next zone of resistance I project is 2173. We break above that, it's going to 2219. That's the next zone of overhead resistance that I have calculated, and then above that 2266. So those are zones of overhead resistance. If at any point, and again, my next time target for stocks, I don't think I mentioned it, or here it is, it's August 19th. So my run time for the stock market is the point in time at which I expect another reversal to occur. I'm oversimplifying a little bit when I say that, but this is where, just to make the bigger point, is August 19th. So essentially I expect the similar behavior that's been in effect for some time now since my last projected time point for stocks, June 29th, see right here, 629, okay, through August 19th. I expect the primary trend to be up for this window between where we are today and August 19th. Then I expect a change in trend to occur possibly into September 22nd. Any questions, folks? That'll complete today. I know I kind of had to rush at the end, but we have recorded today's presentation, so if you'd like to archive it or revisit it, let's see. Questions? Let's see, make sure. Sound is returned. Either I'm a great teacher or there are no questions. Well, let's just, if there are questions, this is the final slide. We offer a discount. Again, this is our information. All of this stuff is, we offer incentives to sign up. And again, thank you, Steve, STE, thank you for showing up. And I always like to share the newest results and thoughts, and from time to time we revisit some old ideas. Again, make new friends, keep the old, one is silver, one is gold. So Peter Newman is the person. If you have questions, if you'd like more detail, it's hard in the context of an hour-and-a-half present webinar to go into detail on any one point. So the thrust of what I attempt to do in some of the webinars is try and present a synopsis, or at least a broad overview of some ideas that I think about in terms of locating good trades. And there's a lot of elements to this business. Those of you who've heard me speak before know I have a passion for this. So if you'd like to know more in specifics on anything concerning the topic for today, or anything related, different webinars, we focus on different things. But today I wanted to highlight the theoretical idea that for me is at the tip of my hierarchical totem pole, if you will, of how I locate good trades. I have made more money with this ultra simplistic idea than every other concept I know, in spite of the inherent complexity of all the other things I look at. The cycle stuff, the time projection analysis, Elliott wave, certainly, the Gann analysis, all of these things, candle formations, you name it, Murray math, whatever, Wyckoff analysis, all of these various things. There's no, indicators and oscillators, all these various relationships, the esoterica and they're very fascinating for me. You can get caught up in that. It's fine to appreciate the implicit beauty or elegance of a concept, but that is what it is. And if that's what you're here for, great. But if you, that necessarily, the elegance and power of a concept or a model may or may not directly or indirectly translate to profitability. So I got into this business to be profitable. And so I realized part of the process is acquiring a set of models analytically that will facilitate an understanding and build your foundation. But again, and so to some extent I focus on a very small wavelength of that in today's presentation, the idea being that the trend theoretically as a tool is my most important analytical kind of weapon, if you will. But beyond the analysis, then again, I alluded to this briefly earlier in the presentation, you must couple that to more greatly guarantee your success with a correct set of protocols on how to work your equity. How to questions like trade sizing, how do you adjust risk assessment, exiting positions that are winning, etc., adjusting risk levels, pyramiding on existing winning positions, etc. All of those types of considerations and necessary concomitant adjustments fall under the auspices of money management. And then lastly, you know, being completely, as Jim Sloman and I guess the Buddha was the primary original author of this, you know, you got to be detached. You know, so that you know, I talk to people who are afraid to pull enter trades because there is money is energy. And so we're playing to establish a position for the opportunity for financial return. I've got to put something at stake. I've got to nothing ventured, nothing gained. It applies in life in many areas. And to the extent that the discipline, the endeavor of establishing positions in a financial market, an instrument, be it a stock, a futures derivative, however complex or simplistic it might be, there is this real world factor of putting up and establishing a financial stake so that we have an investment in something. There's a part of us, and from an energy, we are giving a portion of our energy so that the market, by virtue of its movement, however simple it will be, or Newtonian or non-Newtonian, complicated, effectively leverages that energy. Because that's what financial markets are. They are the real world lever. Who was it, Archimedes, that says, you give me a large enough lever and an appropriate vantage point and I will move the world. And that's essentially what financial markets do. Folks, it has been a pleasure. Again, we have recorded today's presentation. For any details on the specifics of our program or the analysis that I do more particularly, again, the contact person at Pacific Trading Academy is Peter Newman, so that would be the person that you would request. Until next time, I wish you a great weekend and profitable trading in the days and weeks to come.